Hello friends, welcome to our ultimate guide on stock valuation. Have you ever wondered how investors decide what a company is really worth? Imagine if you could unlock these secrets and make smarter investment choices. Today, we'll break down these concepts in simple terms using relatable examples. So, by the end of this video, you'll feel confident in understanding stock market valuations. Picture a company as an apple tree. Its value isn't just about the apples you see today, but it's also about the apples it will produce in the future. This future potential is known as intrinsic value. Investing is all about looking ahead. Innocence Capital puts it well. We're buying windshields, not rearview mirrors. Predicting a company's future isn't easy, but it's crucial for determining its value. Think about two NBA scouts watching a promising young player. One scout focuses on the player's current stats, while the other thinks about the player's potential in the future. The same applies to valuing a company. Some investors look at the current earnings, while others look at potential growth. Stock prices fluctuate based on the opinions of buyers and sellers alike. In the short term, these prices can be quite volatile, much like how the weather can change from day to day. However, in the long run, a company's value typically aligns with its ability to generate profits. Two important terms to know are market cap and enterprise value. Market cap is the total value of the company's stocks, where enterprise value adds the company's debts and subtracts its cash. These metrics help us understand the company's overall value. For example, think of tech giants like Apple and Nvidia. Their market caps hit milestones of $3 trillion and $1 trillion respectively. These numbers reflect how investors value their potential to keep growing and generating profits in the future. Have you ever thought about how these numbers actually impact their valuation? If so, let us know in the comment section below. Investors use different tools to figure out how much a company is actually worth, much like how a gardener uses various tools to tend to an apple tree. One common tool is the price to book ratio, or PB ratio for short. Imagine valuing an apple tree based on its trunk and branches, ignoring the apple it produces. The PB ratio compares a company's market cap to its book value, which is its assets minus its liabilities. This helps investors see if a company is valued beyond its tangible assets. Next is something called as the price to earnings ratio, or PE ratio for short. This compares the stock price to the earnings per share, or EPS, and indicates how long it would take to earn back your investment if earnings stay the same. But businesses change and earnings fluctuate. So it's important to remember that the ratio is like estimating how many years it would take for an apple tree to produce enough apples to cover its cost. Then we have the price to earnings growth, or the PEG ratio for short, which refines the PE ratio by factoring in expected growth rate. It's like considering not only how many apples the tree produces now, but also how many more it might produce as it grows. This gives a more complete picture of the company's future potential. Another essential tool is the discounted cash flow, or the DCF analysis. This method values a company based on its future cash flows, much like predicting how much money an apple tree will generate from selling apples over the years. It's a detailed process that requires forecasting future profits and then figuring out their present value. Do you think predicting the future is easy? Well, not quite, but it's absolutely essential. Finally, there is another method called as the reverse discounted cash flow. This method works backwards, determining market expectations for future profits based on the current price. It's like figuring out how much rent the market expects you to collect based on the current property price. Each tool has its own strengths and weaknesses, providing different insights into a company's value. Think of them like different tools in a toolbox. Sometimes you need a hammer, other times you might need a screwdriver. Which tool do you think is the most important? Let us know your thoughts in the comment section below. Just like living things, businesses go through different life stages. Understanding where a company is in its life cycle can help you grasp its true value. For instance, think of a young apple tree that hasn't produced any apples yet. This is like a startup company with no earnings, where the valuation depends upon the potential exit strategies such as an acquisition or an IPO. An example is OpenAI. Then there are hyper growth stage companies where the apple tree is rapidly growing, focusing on expanding its branches. Earnings might be low because the company is reinvesting in growth. Snowflake is a perfect example of this stage. Next, we have self-funding stage. Here the apple tree has started producing a few apples but still needs care. The company is breaking even with the potential for future growth, just like companies like Uber. As the apple tree matures and starts producing many apples efficiently, the company enters the operating leverage stage. Here, it's expanding margins with room for improvements like Salesforce. Finally, we reach the maturity stage where the apple tree consistently produces a good number of apples every year. This is when the company has steady, predictable growth, for example companies like Visa. However, some trees like companies enter into a decline stage. That apple production dwindles and earnings decrease. The P ratios might look attractive, but they can be misleading. An example is Bed Bath & Beyond, where the company's best days might be behind it. Evaluating a company's stage helps in applying the right valuation metrics. Have you noticed how different companies you know fit into these stages? If so, share your thoughts in the comment section below. The DCF model attempts to predict a company's future earnings and then determine their present value. It's like guessing how many apples an apple tree will produce over the next 10 years and what those apples are worth right now. While helpful, these models have significant catches. Predicting the future is tricky. Will the apple tree stay healthy? Will it face bad weather? Similarly, predicting a company's future profits can be challenging. The DCF model are also very sensitive to small changes in assumptions. Even slight variations in growth rates can significantly alter their value. It's like trying to hit a moving target. Additionally, these models assume consistent future earnings, which might not account for new competitors or technologies that could disrupt the market in the coming future. Moreover, DCF models use something called as terminal value, which is a way to estimate the value of all future profits beyond a certain point. It's like guessing the total apple yield of a tree 20 years from now. Can we really predict that far into the future? Well, DCF models are useful, but they're not foolproof. They should be one of many tools in your valuation process. Do you think it's wise to rely on just one model? Let us know your thoughts. Just like beauty, value is subjective. Different investors perceive value in various ways depending on their goals and strategies. Imagine an auction where one person bids high enough because they see potential in an old painting, while another person bids low because they view it as just an old canvas. Similarly, investors have different styles and philosophies. Value investors like Warren Buffett look for steady cash flows and buy undervalued shares for the long-term gains. They see the apple tree's current health and consistent apple production. Growth investors like Cathie Wood focus on companies with significant growth potential. They imagine the apple trees growing bigger and bigger, producing more apples in the future. Then we have event-driven investors like Carl Icahn. They invest based on specific events or catalysts. They might bet on a new fertilizer that could double the tree's apple output. Momentum traders like William O'Neill rely on market trends and short-term price movements. They watch how the market reacts to the apple tree's performance. And then we have venture capitalists who invest in early stage startups, high growth tech companies, planting a young apple tree, hoping it will grow into a giant orchid. Contrarian investors like Michael Burry seek undervalued or overlooked assets. They find an old apple tree in a neglected orchid, believing it has potential. Understanding these different investment styles will help informing your own investment philosophy. Which style resonates with you the most? Share thoughts in the comment section below. And that, my friends, is a wrap on our ultimate guide to valuing stocks. If you enjoyed this video and found it helpful, please hit the like button, share it with your friends, and subscribe to our channel for more investing content. Remember, investing wisely takes time and understanding. So keep learning, stay curious, and let's grow together. Until then, stay safe, and I'll see you all in the next video. Bye for now.